All right, let's talk about a number you see everywhere in finance, a number that moves markets and makes headlines. But here's the thing, it's probably the most misunderstood concept out there. We're talking about market cap. So let's just start with this number right here. Negative $174 billion. That's how much value the media said Nvidia lost in a single day. I mean, that's just a mind-boggling figure. But it makes you stop and think. How can that even happen? Seriously, on that day, Nvidia didn't shut down any factories, they didn't lose a massive lawsuit, their business was fundamentally the same at 4 p.m. as it was at 9 a.m., so where did all that money go? Well, that's the big illusion we're going to unpack today.
And look, this isn't just some quirky story about one tech company. This is about a fundamental misunderstanding, an illusion that literally directs how trillions of dollars move around the global economy. And if you've ever felt a little fuzzy on what it really means, you are not alone. Not by a long shot. Studies have shown that over 60% of individual investors, 6 out of 10, can't accurately define market cap. And that knowledge gap can be really, really costly.
So let's get into it. We're going to pull back the curtain on the math behind this number, because on the surface it looks incredibly simple. But there's a hidden flaw in that simplicity that changes everything.
Here it is, the formula you'd find in any textbook. You just take the current share price and you multiply it by the total number of shares the company has. You know, if a stock is trading at $100 and there are 10 million shares out there, boom, it's a $1 billion company. Easy, right? Well, that simplicity is exactly why it's so misleading.
Because here is the critical flaw, the secret ingredient that makes the whole thing so volatile. That current share price, it's not the value of all the shares, it's just the price of the last few shares that were traded. We're talking about a tiny, tiny fraction of the total. So the price is set by a handful of transactions at the very edge. But then that single price gets multiplied across every single share in existence, even ones that are locked away and haven't moved in years. Okay, think about it like this. It's the best analogy I've heard. Imagine you live in a neighborhood where all the houses are identical, and yours is worth, say, 500 grand. Now, what if your neighbor gets a job on the other side of the country, panics, and sells their house for a quick $450,000? Did the value of your house just instantly drop by $50,000? No way, of course not. But that's precisely how market cap works. And to make it even more complicated, there's this idea of the free float. See, total shares includes everything, but the free float is only the shares that are actually available for people like you and me to trade. Huge amounts of stock can be held by insiders, founders, or other governments. They're not trading it day to day. So that means an even smaller pool of shares is setting the daily price for the entire company. And all of this leads us to what is probably the single biggest lesson in investing, the thing that separates the pros from the amateurs. And that is, market cap is not the same thing as a company's true value. They are two very different concepts.
I mean, we see headlines like this all the time, right? The language itself kind of tricks us. When we hear a $3 trillion company, we automatically think that's what it's worth. But what the headline is really saying is that its market cap hit $3 trillion. And that's just a snapshot of the stock market's mood on one particular afternoon.
So let's just lay it out. Market cap. That's just what the market is willing to pay for a tiny slice of the company, right now. Multiply it out. Company value. That's about what the business is actually fundamentally worth. It's based on things like its assets, its brand, and, its ability to make actual money, cash flow, for years and years to come. Sometimes they're close, but boy, can they get far apart. And if you want a perfect dramatic example of that, just remember the whole GameStop saga in 2021. The market cap went ballistic. It shot up to over $24 billion. Now ask yourself, did the fundamental business of selling video games out of brick-and-mortar stores suddenly become that valuable? Of course not. It was pure speculation, a social media frenzy. The market cap was completely unhinged from reality, and, as you can see, it eventually came crashing back to earth. Okay, so now that we've seen all the traps and all the pitfalls, how do we actually use this number the right way? How can we turn it from a misleading headline into a genuinely useful tool and avoid some really common mistakes?
Let's start with a classic one, the cheap stock fallacy. Okay, quick quiz. Look at these two companies. Company A's stock is just $10 a share. Company B's is $100. Which one is cheaper? Well, a lot of people would immediately say Company A. But when you look at the market cap, you realize Company A is a much, much bigger company overall. The stock price by itself is almost meaningless. So let's nail this down. Here are 3 super common, really costly mistakes to avoid. Number 1, thinking market cap is the buyout price. It's not. An actual acquisition always costs more, a premium. 2. Market cap completely ignores debt, which is a huge piece of a company's financial health. And 3, like we just saw, never, ever assume a low share price means a stock is cheap.
What's really wild is that this whole concept actually shapes the entire market. See, most of the big indexes you hear about, like the S&P 500, are market cap weighted. That means the bigger the company's market cap, the more influence it has. Right now, the top 10 companies make up over 30% of the whole index. This creates this weird feedback loop where money flows into index funds, which then have to buy more of the biggest companies, pushing their prices and their market caps even higher. So, how should you use it? Think of it in 3 smart ways. First, it's just a starting filter. It lets you quickly sort companies into buckets: small cap, mid cap, large cap. Second, it's a context clue. You use it as part of other, much better ratios, like the price-to-earnings ratio. That tells you a way better story. And third, it's a quick and dirty check for liquidity. A giant market cap usually means it's easy to buy and sell without moving the price too much.
At the end of the day, market cap is a tool. It's not the truth. It's a measure of popularity, not necessarily of quality. It tells you what the crowd is thinking today, but it doesn't tell you what the business is actually worth tomorrow. So the next time you see one of those screaming headlines about billions being made or lost in a day, I hope you'll see more than just the number. I hope you'll see the story, the psychology, and the fascinating reality hiding just beneath the surface.